Welcome back to AgriTalk. We are in the middle of a conversation with Philip Streible, Chief Market Strategist at Blue Line Futures. All right, Philip, we've talked about what got us up to that all-time high, 43.60, we'll call it. That was last Monday at 43.60. Since then, on Wednesday, we were all the way down to 40.65. Today, 40.10. What's going on?
Well, today you got a sell-off here because of the fact that we do have some kind of framework agreement between the U.S. and China as far as, a trade deal. So much of the rally that is attributed to the gold market has been those concerns about the potential trade war. And with those being alleviated, you start to see other outside markets that are like finally able to breathe. And there's a sense of relief because China has been that gorilla that needs to be let loose here. And what we're seeing is that, U.S. equity markets across the board, we're making as this recording is going on, we're making new all-time highs in the S&P, the NASDAQ, the Russell 2000, even the Dow Jones, all pushing on up. So you've got this rotation out of this safe haven trade at the moment in a little bit of a pullback back to a longer-term support, psychological 4,000 level, and chasing some of these U.S. equities higher.
Okay. How does what has happened in gold work with the U.S. dollar index at 98.80? Is there any influence of the precious market, the precious metals on the dollar trade, or vice versa?
So at certain periods of time, what we'll do is we'll run a correlation matrix against key different commodities against different currencies. And what we'll see is that during periods of time, you'll see an inverse correlation between the US dollar and the gold market. But recently here, it's about a 75% positive correlation. So that's why the dollar index being a little bit lower, and then also the gold market being a little bit lower here, well, significantly lower actually today on a percentage wise, down about 3%. So you're seeing that positive correlation play out. What happens is when you get these uncertainties and they become unglued and people are free again, they start to repatriate back into their currencies. So if you look at like the Australian dollar, well, that's the best performing commodity out there. Who's their number one trade partner? That's China. China-U.S. trade tensions coming down. And now you could see some of these global economies kind of lift back up.
Okay. I like it. Do you feel like the drop in gold today supported the move in beans or confirmed that there is a trade agreement out there?
Yeah, what's funny is that when I was coming on this program, I didn't know if I should wear my Make Silver Great Again hat because we're down 3%, or should I be wearing my Make Soybeans Great Again because we're back near the 1-year highs. We're getting close. We're closing in on that, up about 2.3%. My question when it comes to like the agricultural markets is, the farmer, when those beans dipped below $10, there was a lot of uncertainty. And that was the same day that Trump announced that we're going to get a deal with China. We're going to talk to them about purchases. We saw beans reverse sharply on that news. They consolidated. Now we get this possibility of a framework deal. You've got Scott Bessent coming out and saying that they're going to be purchasing a lot of beans. I never thought in my life I'd hear soybeans and fentanyl in the same sentence. That drives me nuts, but a totally different conversation. But beans coming up, breaking out to the upside, key level, I think 1087. That's like the 1-year high. And we could see if we could go from there. But I think also a lot of farmers uncertain that this could hold. We might see some selling and some hedging pressure come back onto the market because these guys, they're feeling, they were uneasy at $10, what I'm saying. Now they're feeling pretty good. Let's put some hedges on.
Okay. All right. Is there a line to draw from what has happened in gold to what is happening in the crude oil market, Philip?
Well, in the crude oil market, you've had prices consistently cycling lower. Look, you had the craziest geopolitical event of all time, at least during my period of time, where we're dropping bombs on nuclear facilities in Iran, and oil prices were barely able to breach $80 for a
Yeah.
moment and close
Yeah.
significantly lower on that day. So that tells you is that the triple digit oil, the $150, $200, that doesn't exist. That story doesn't exist. They can't close the Straits of Hormuz. They can't upset the surrounding countries in the Middle East. So prices, what's happening now is you're seeing that, the US is coordinating with other countries. They want to get China, they want to get India buying from countries that are not Russia. Saudi Arabia, OPEC is stepping up. They want to fulfill those needs. And then that's where you get prices starting to come down. They thought there would be a small supply disruption last week. Prices went from $56 on up to about 63 because we targeted some of those Russian oil producers. Now we're seeing OPEC say they want to increase production again. Prices are in the red here today as this recording. So I think that series of lower highs, Trump wants to get oil in the mid 50s. And I think that nearly everything we've seen him want to happen has happened. So I don't see any reason why not to think it won't happen.
Okay. All right. I'm going to keep going through the markets and looking for connections and how they all tie together. Got the 10-year Treasury just under 4% here this afternoon. What are you thinking on interest rates?
Well, we still so 4% is kind of a bull bear line. Interest rates have made a series of lower highs on the chart. You look at the CME's Fed Watch tool, we got about 97% chance they cut 25 basis points on Wednesday. You go out to the December meeting, we've got a 97% chance that they cut 25 basis points there. So we are in this period of falling interest rates. What that's benefiting is it's taking a lot of cash that is sidelined, okay? We have an abundant amount of sidelined cash. We've got record high balances in money markets, $7.7 trillion. That large pool of capital is ready to be deployed. As short-term interest rates fall, that money is more likely to flow into U.S. equities, other assets, further providing support in these markets. So that's why, again, you've got equities continuing to charge higher.
Okay. All right. Well, that's where I want to go next because you've mentioned it a couple of times. Here we are. We've got all the indices making new highs, basically. Can that keep going?
I think so. And I'll tell you why. It's the technological innovation that's happening. This AI boom has been the main driver of the current rally. It's propelling growth in the technology sector. It's driving outside earnings for key companies and transforming many industries. Now, you look at many people use Facebook and many people wear sunglasses. The two are connected through the Meta AI frames. These look like normal sunglasses. I went to a Luke Combs concert over the weekend. I didn't have to pull my cell phone out once. I'm wearing these sunglasses that are transitioning to where it gets night at the concert, and I'm able to record in 4K and not pull my phone out, look around and have a great time, not be one of these goofballs holding their phone in the air. And it's these technological advances that are just occurring under the hood of everything. You've got the favorable monetary policy, the cut rates, and the broadening, strengthening of this market. So you get the NASDAQ up 2.3% last week, new all-time highs today, 10% in the last 3 months. And the broadening goes where the Russell 2000, these are the most hated, the small caps. Well, they're getting the best of all worlds. They're getting declining interest rates because they've been debt burdened. They're non-profitable. And all of a sudden, they're becoming more dynamic in nature. They've got AI running in the background, making these small businesses more streamlined. And what we're seeing is that their earnings growth is up about 25% year over year. They're up 2.5% last week. They're up about 11% over the last 3 months. And then you look at the earnings of these companies like the S&P 500, 145 have reported so far, 84% have managed to beat the forecast, and only 14% have missed. And chances are the ones that have missed have not adopted to new technology.
Yeah, interesting. Really interesting. Not a lot of time, but I'm going to jump here. Is silver just riding gold's coattails?
It's 9 times smaller than gold, so it's going to be much more volatile. It tends to overshoot. You did have a dynamic squeeze that occurred where it was fueled by tighter inventories in London that were backed by physical. In a nutshell, what happened was India switches from buying gold to buying silver because it's cheaper and people just want it. That comes at the time that China shuts down for a week. Now all of a sudden India's cut off. They sell off across, they sell out of their warehouses across the country. They got to go over to the London market. That's where they start buying. And they don't realize that all the London silver is backed by physical ETFs. So there's a small float out there. Prices blow through 50, go to $53. Since then, lease rates in London have fallen dramatically, hitting 5.6%. That's why you got a $1.80 sell off here today. So it's just come a little bit more normalized. Silver does face a little bit of substitution risk as you go up. It can be substituted out. So it has that demand destruction with copper and other metals such as aluminum could replace silver in certain industries. So you get a little bit of rotation going on. But I don't think silver's down for the count. I think we could run up to 65 next year. You got increasing EV, green energy, AI, solar. All the framework is there to keep it going.
Yeah. My gosh, Philip, we covered a lot of ground in that 20 minutes of conversation there. Thank you so much for bringing your insights and your perspectives, your knowledge here over to AgriTalk, okay?
Thanks a lot. Thanks for having me on.
You bet. Philip Streible, Chief Market Strategist at Blue Line Futures. Man, oh man. Okay.